Okay, thank you for tuning in. Good morning, everyone. Today's Sunday, and it's about 10 minutes of 8 a.m. Pacific Coast time. And futures will open in about 8 hours. Anyway, what I want to cover in this video is a trade I put on a few days ago, Thursday. And this structure and the way I'm dealing with it, handling it as far as modifications are concerned, is emblematic of what can be done with a relatively small or minor outlay. Let's get into it. All right, the current structure looks like the following. And by the way, I did this in the small account I have over in Tasty, which I opened in the beginning of April with $5,000. So keep in mind that this is a very small account. I wanted to use it to put on some trades in options and futures and other 1256 contracts. SPX qualifies as one of them, and the reason I favor the 1256 category is because of the blend between 60/40 long-term gains, short-term gains. It's a favorable tax structure as opposed to using this account for options on, or this particular account, it's a taxable account. This particular account for options on, let's say, something like stocks or non-1256 instruments. All right, anyway, back to the video, back to the structure. What we have here is a vertical spread, and I'll get into the details of the components. At the time I put it on Thursday, this was I put on an out-of-the-money vertical spread 10 wide. And the strike lines were 74, 30, and 20. And that was it. That's what I did Thursday. Let me see what time. 12 p.m. Pacific time. So an hour before the market closed on Thursday. And to put this trade into context with where the market was at the time, let me go back to Thursday at noon. So that was the 15th. Yeah, here we go. Okay, so Thursday at noon, the market was not near the high of the day, but oh no, this is the 15th. So let me go to Thursday. Here we go. So Thursday at noon, the market was near the high of the day. Let me expand this a bit. All right, push it out. Let's go to just 2 more bars. So it was sitting in a very tight range for this half-hour candle. And by tight, I mean real tight, not even 7 handles. So the high of this half-hour bar was 75.08 and the low was 75.01. In that range, when I put the trade on Thursday afternoon, an hour before the close. So the market's, let's just say it's sitting around 75.05-ish, okay? Then Thursday afternoon, Thursday night, the market, let me go to the futures so we can see what was going on. So set this back up. Okay. So Thursday, the futures and the basis between emini futures and SPUs at this point was probably 23 handles. So we have to make the corresponding adjustment. Let's see where we were trading. So if the cash was at 05, then the futures were probably somewhere around a couple pips under 30. And we can see that the high here was 75.31 at, let's go to 12. Okay, so if we were at 05 in the cash, and let's just take the rough equivalent here, we're going to be roughly probably around 28 in the futures. And later that afternoon, we can see that the market started to drop a little bit. And as the afternoon progressed into night, the market continued to drop, slowly descending. Also, I do want to mention that Thursday and Friday was those 2 days we sent a delegation of business executives to China with the president. And I did happen to notice that Boeing was down $10 that day, and Boeing, Friday morning, and Boeing was expecting to sign some sort of deal for China to buy planes. I don't know what happened with that, but that was probably not good for the market. And I'm not saying that, I don't want to suggest that things didn't go well as far as that meeting between us and the Chinese. You have to keep in mind that, sure, possibly, but this drop in the market is not necessarily was not necessarily caused by the meeting in China. Keep in mind that prior to this high, the market went up for 3 years in a row, 1% a day, without so much as a 1% pullback. That, as far as I know, is probably some sort of record, but the market was rallying quite a bit. So some sort of pullback is normal, expected, healthy, and didn't necessarily have anything to do with what was going on between us and China. So I do want to be very, very clear about that. And anyway, the market went down. Okay, so Thursday afternoon, I put on the following trade an hour before the close. I bought, this would be, let's say we were trading around 05, 75, 05, as I mentioned, in cash. So I went roughly 70-ish, 75-ish handles out of the money on a 10 wide, and I paid $1.40 for it. So this was somewhere between delta-wise at the time of execution, somewhere between maybe 15 and 20 delta. That's a rough guesstimate off the top of my head. All right, so notice that this is still a small account, and I had some other positions on, so I wouldn't have bought more than 5 of these here, and I was working some other orders. I got filled on 2 for $1.40, and I do want to also emphasize that keep in mind that this is a small account, and I'm not suggesting that people start piling on for $1, $1.50 at a pop, spreads 5, 10 wide, whatever, and buying whatever $1,000 worth. Let's say you're buying into a small poker game, 500 or $1,000. I'm not suggesting people do that. This is just something I did, and I'm going to go over what I did, but again, this is emblematic of something that's possible with a small account. So worst case scenario here, I lose 142 times, $280. No big deal. I don't care about that. But again, keep in mind, I'm not recommending that people do that because that would be touchy irresponsible on my part. So I do want to emphasize that. All right. So we have a 10 wide spread out of the money. The strikes are 30 and 20. And the total outlay was $280. The next morning, the SPOOs, cash was trading about, opened roughly 70 lower, and then it was trading 80, 90 lower. So I decided to peel off one of the spreads, and I sold it for $5. All right, so what does this do for me? Well, for one thing, notice that the difference between the credit I received for peeling off one of them and the price I paid for both, this leaves me with if I were to do nothing else at this point, nothing at all, a guaranteed profit of the difference of the credits. So I would have a guaranteed profit of $220 if I did nothing. And note that I still have on a 10 wide vertical, which can max out at $1,000. So I can make the 1,000 on the max value of the vertical plus the difference, the profit between what I pulled in and my cost for buying into the game. All right, so that would be a $1,200 profit potential, and the worst case scenario would be a $200 win if I were to do nothing. But that's not the way I do things. So let's take a look. Let's take a look at a breakdown here. So let me break it down this way. I have the original spread plus, peeled one off. So let me get rid of this. Okay, so I have the original spread, the 10 wide, and this was from Thursday. I paid $1.40 for it, so it cost me $2.80. And then I sold one of them. I peeled off one of them to harvest some profits and eliminate the risk. So the ensuing position is the following. I still have a 10 wide between 70.30 and 70.20. The worst case scenario, I make a touch over 200. Best case scenario, the vertical spread maxes out for 1,000 and I get the extra 200 in profit from peeling off one of the two spreads that I initially purchased. All right, from that point, the market remained lower for most of the day, but in at least surprising to me, a somewhat tightish range of, I want to say 15 to 20 handles. And since it didn't look like at that point there was going to be a ton of follow through, and by at that point I mean 8:06 a.m. Again, this is PCT, Pacific Coast time. So the market's open for a little more. The market was open for a little more than an hour and a half, and I decided to sell a 5 wide. Notice I did a 74.10, sold that, and I bought an 05. So this creates a condor, and this brings in $175 of credit. And let's see what that position looks like. So I sold the 10.05 for $1.75. So now I have the 10 wide vertical, and I have a 5 wide condor. So at the max, at the beginning of this plateau, we'll call this the apex plateau between the 10 wide, which is at 20, ends at 20, 30 to 20, and then the 5 wide, which begins at 10 and ends at 05. I have basically a 5 wide condor here. You can look at it that way. That's one way of looking at it. And then I have this extra 5 wide, let's call it between 74.30 and 75.20. You can look at it either way, but since this one is 10 wide and this spread that I sold is 5 wide, I still have an extra 5 to play with here. So again, let's say that I don't do anything beyond this point and the market rallies and all these go to dust. So what happens with my P&L? Well, in the worst case scenario, I make around $400. If the market settles at expiration, which is tomorrow, Monday, between 20 and 10, I get to make $1,400. And between 10 and 05, for each point that the market drops, I lose. Well, I don't lose, but I will make $100 less than the apex of 1,400. So at 05, if it pins there, I would make a little, basically $900. And anything below 74.05, I keep at least $900. So that's the resulting structure. And that was built by buying the 2 lot initially. That was 10 wide. Selling one of them, bringing in a credit of $5. And these prices here for this, I know are not exact. I don't remember what they were, but I know the credit was $5 as we can see. So I just threw in 27 and 22. I could have thrown in 200 and 195. The result will still be the same because it's $5 of credit. Anyway, I sold one to, again, harvest profit and hedge risk. And then I decided to play with the 10 wide that I had left by selling this 5 wide to bring in a credit of 170. So note that the total credits here are 395, which means this structure, the worst case scenario is I make $395. So again, that illustrates that with a small outlay and a favorable move, yeah, you can make a decent return for the cost of buying into the game. Okay, let's continue. So 8:06 a.m. I sold 5 wide, as I mentioned. Then at the end of the day, I was thinking about what I wanted to do. And I could have just closed down the whole thing, but I still had time. I had the weekend. The market moved lower at the end of the day. Let me adjust this to 5-minute candles. So in the last half hour, I want to say the market, how many candles we have here? 3, 15 minutes to a half hour. The market dropped from, let's call it, sitting around here, 74.30 to 40. The market dropped to near the lows of the day, not quite. I started to see it trading around 74.10-ish. And given this setup, this particular formation, if you want to call it that, given this formation, if I had to make a decision about what I wanted to prefer as far as being long or short over the weekend, I would go with, okay, I want to be short. And I have a position that benefits from being short. And it also benefits from the market not moving much or moving a little bit in either direction. A little bit to the downside would obviously be better. So what did I do? I could have done nothing. I could have closed down the entire position. Did not want to do that because rather than make maybe this, I have a shot at making 1,400 over a small range. But I still want that shot. I paid for it. I took risk for it. And if the market goes down, I can still make $900 or just a touch under $900. So I want to keep this live. I want to keep it in play. However, I did do something. And what I did was I noticed that the spreads that were trading roughly 100 points away, the 73 even, the 72.95, were going for 50 cents. And I decided to turn the 5 wide that I still have on. Okay, I still have this 5 wide I'm playing with, or you can call it this one, whatever you want. I still have a 5 wide that's free. So I decided to sell a 5 wide 100 points away for 50 cents. But I didn't sell one, I sold 2. And why would I do that? Well, let's take a quick peek at what this actually does to the position. So now I'm introducing, let me do this. I'm introducing downside risk a bit because I'm still long a 5 wide, but now I'm short 2 5 wides all the way down here, 100 points away, 100 points away. Now, why would I do this? Well, because since I already had some a decent minimum worst case scenario of basically, let's call it $400, I'm not going to concern myself with the extra 500 that I lose on the downside because it's 100 points away. And near the close of the day, at the close of the day, the at the money straddle was trading for around 57, 58 points. So with an estimated move of, let's just say, somewhere between 50 and 60 for Monday, and the opportunity to put on an unbalanced condor, a 5 wide, by 2 5 wides on the other end of the spectrum, I bring in an extra $100. I bring in an extra $100, $50 credit 2 times, and I lift the profit tent here by $100, which is basically the credit that I brought in by selling this. All right, so note I went from $3.95 here to $4.95 because I sold 250 centers, and that brings in $1, and it leaves me with the following structure. All right, so I have potential $1,500 profit, albeit over a small range, a very small range up here, and then below 74.05 all the way to 7,300. with an expected move of somewhere between 50 and 60. I don't know what's going to happen when futures open this afternoon. Nobody does. I don't know what's going to happen overnight. Nobody does. But I got 100 points here, 105 points, where I can make $1,000, and I can deal with this. I can deal with this tomorrow. And how might I deal with it? Well, let's take a look. What did I do here? Do I have? Okay, let's go to the original. All right, so something I can do is, remember I sold the 7,300, 7,295 for 50 cents. I can butterfly off this downside risk, and I can also sell another spread up here and butterfly it off over here. I'm not saying I'm going to do that, but if I were really concerned about the market going down far enough past 7,300 so that whatever profit I had of just under $500 will go to dust, then I can do something. I can sell a spread here to butterfly off this risk, and I can bring in a credit for the whole package by selling a 5 wide here, because let's say the market's trading in between. Well, this 5 wide is going to be worth more than this 5 wide, and we closed at 08. So if the market opens around here on Monday morning or a little bit lower, right, the delta on this 5 wide spread is going to be maybe somewhere around 60, 65. So I can probably sell this for around $3.50. I don't know, maybe $4. It depends where the market is. And as this starts to bleed off theta, I have time decay on this. Who knows? Maybe I can sell the 5 wide here for $3.50 and buy this back for whatever I paid for it or less. So what will it leave me with? A decent profit of, let's say, somewhere around $1,000, $1,100, $1,200, maybe a little bit less, over 100 wide range. I'll have pin the tail on the donkey on a 2x2 butterfly. So that can bring in a nice profit. And I still have this. And all of that was done for measly credit of, or a measly debit of, let me go back to the beginning here, a measly debit of $280. All right. So that's what's pretty cool about understanding how to make adjustments. If you want to make an adjustment or several, you don't have to do anything. I could just close out the current position, or imagine if you still had both of the original spreads on. All right, maybe you could sell them for $700, $800. You could bring in $1,400, $1,500, $1,600 on your 2 lot, and it costs you $280 to buy in. All right, you buy in for $280. You sit down, you get dealt your cards, and you leave the game with $1,500, $1,600 or more. Maybe you leave with $1,000. That's not too bad for a $280 risk. Your profit relative to the buy and the risk can be pretty decent on these. Of course, you're going to need some sort of a favorable move. Having a favorable mood also helps, but you need a favorable move. And then if you get it, know what adjustments you want to make and how it will affect the structure of the trade. You start with something very simple. You adjust, you adjust, you adjust. All right, I hope that was helpful. Good luck to everyone. Catch you next time.